So for today, we are going to do a question of November 2016. That is financial reporting section 3. And this is the relevant question. Because now for financial reporting, I think I shared some of the theory which are in that relevant unit. And most of the 70% is computations. So 30% of the exam is the one which comes from the theoretical part. That is why mostly I concentrate on computations. Then theory, I always share an handout which you can be going through. Then towards the end of the semester, towards the end of our classes, I will come later to check, to go through some summarized notes. But for now, make sure you have been going through the notes I shared to your WhatsApp. Those are the materials we are using, the notes we will be using, plus the addition I will give you during the class time. So question 4, they said the following information was extracted from the financial statements of A, B, and C for the year ended 30th September 2016. You have the statement of financial position as at 30th September 2016. So whereby you have A, B, and C. So non-current assets, you have the relevant non-current assets, current liabilities. So you don't have to read these statements because you know statement of financial position contains assets and liabilities and a part of the equity. Then additional information they are saying then, A Limited acquired its investment as shown below. They acquired B and C. Number of shares acquired 16 and 3. Cost of investment for 80 and 120. Retained earnings 150 and 100. Date of acquisition 1st October 2014, 1st October 2015. As that is not as A Limited also invested in a half of the 10% debentures in B. The fair value of the non-controlling interest in B amounted to shillings 120. Immediately prior to the date of its acquisition, B revalued its non-current asset in readiness for the acquisition as shown below. So before I continue to note 2, so you can see note 1, you are given the number of shares which were acquired in B and C. You are given the cost of investment. So if you take the cost of investment of B, you add with that of C, you are getting which figure? That is around 600. So the total, this total here, for 80 plus 120. Remember that A is the one which made the investment. So A made an investment in B of 480 and in C of 120. So the investments which you have in the statement of in this statement of financial position here is supposed to be equal with the one they provided in the additional information. So you can see the investment under the non-current asset is 700. So you can see on the other side B and C we have dash dash because it's under A. Why? Because A is the one which made investments in B and C. A is the one which made investments in B and C. So that was 700. But here you can see it's 600 for 80 plus 120. So there's a difference of 100. Where is this 100 coming from? That is why they said that A Limited also invested in half of the 10% debentures of B. A Limited also invested in a half of 10% debentures in B. So he invested in the debentures. So a half of the 10% debentures in B, this is the 10% debentures. In B, this value was 200. So a half of that 200 is that 100. And that is the difference. Then see the fair value, they said the fair value of non-controlling interest in B amounted to shillings 120, which implies that when you will be computing the goodwill of B Limited, when A will be computing the goodwill of B Limited, he has to use full method. Because for you to use full method, for the parent to use full method in that subsidiary B, it must have been provided the fair value of non-controlling interest. And that fair value of non-controlling interest has been given. So for you to use full method in any scenario, the parent to use the full method in the computation of the goodwill of the relevant subsidiary which was acquired. In that subsidiary, remember there's an element of NCI, the percentage which was unacquired. That NCI must be measured at its fair value for you to use full method. Number two, immediately prior to the date of its acquisition, B Limited revalued its non-current assets in readiness for the acquisition as shown below. We mentioned about revaluation in our last sessions, whereby I said that the revaluation is the difference between the fair value, the difference between the fair value of an asset. Let's say, for example, now the fair value of the assets of B and the book value of those assets. So the difference between the fair value and the book value of the asset, the difference between the two, of which you will find that the fair value is in excess. The fair value will be in excess of the book value, because obviously the fair value, the market value is in excess, it will be higher than the book value. So that is how now they can twist in an exam situation and tell you that the fair value of certain assets for a certain subsidiary was in excess of the book value. Or they can say that the book value was below. The book value of certain assets in a certain subsidiary was below its fair value. And that is what they have provided you with in additional information number 2. They have said that immediately prior to the date of its acquisition, B Limited revalued its non-current asset in readiness for the acquisition as shown below. Item, carrying amount, fair value, remaining right. So you can see you are given the carrying amount. Another name for the carrying amount is book value. And another name for the fair value is the market value. So the difference between the two, like now for equipment, our revaluation will be 40. So you take 290, which is higher than the book value by 40. The same with patents. We have 10, 160 minus 150. Then I said last time that, and I can repeat again, when we have revaluation, it does to read us to what we call depreciation undercharge. Because obviously you will find that, like now in this scenario, let me use an example of equipment. When they were subjecting this equipment to depreciation, they used the 250. But you can see now the asset has increased in value by 40 to 290, the fair value. So this 40, the increase was never subjected to depreciation. That is why we say that they did a depreciation undercharge, whereby we have to check the depreciation which is inside the 40. So the depreciation element, which would be inside this 40, this element of revaluation. So that is whereby you take your revaluation, you divide with the remaining useful life. If you are provided with a percentage, that is the depreciation rate, you take your revaluation, you multiply with the depreciation rate. Number 3, during the year, A Limited, during the year, A Limited sold an non-current asset to B for 180 million. A Limited marked up the equipment at 20% on cost. B Limited included the equipment in its non-current asset and charged depreciation at the rate of 20% per annum on cost. So when you hear a statement of this kind, whereby one entity is selling a fixed asset to another entity. Like now you can see A is selling an non-current asset to B. So when there's an intergroup sales of a fixed asset, the other entity which will receive this fixed asset will never resell it. Fixed assets are not meant for resale. That is what I mean. So which means that now when B will receive this fixed asset, he will never resell the fixed asset. But remember that when A was selling to B, he gained, whereby A marked up the equipment at 20% on cost. So since A gained, he included, which I mean he included a profit. So this profit can never be realized by B because B will never resell the asset. That is what we have said. So we have to go ahead and compute the unrealized profit on fixed asset, UPFA, unrealized profit on fixed asset, whereby we have to take the transfer value, the 180, we multiply with the profit margin. So if you are given a profit markup, you have to change it to margin. And you will see that once I will be doing the question, how to change. Then after doing that, remember that if there's an intergroup sales between two entities, they will obviously tell you that they charge depreciation. So both of them, right now in this scenario, A subjected this asset to depreciation. B receiving the asset, he will subject that asset to depreciation. That is what we call depreciation overcharge. They are group members. Group members means parent and or its subsidiaries. So if they subjected depreciation on this asset, both of them, it means that they did a depreciation overcharge. And that one implies that they understated the value of the asset. They understated the value of the asset. So we need to determine the depreciation overcharge so that we add back to the PPE, the property, plant, and equipment. So which means that we have to debit PPE and again adjust our retained profit by crediting. But never worry about the double entries. The main purpose is, do you know what to do in that additional information? For the others, I will tell you this is what to do. This is where to adjust. This is where to add. This is where to subtract. And why do you do that? But first, can you identify what this statement means in an exam situation? Number 4, B Limited sold inventories to A Limited during the year for shillings 150 million. B Limited marked up these goods at shillings 50 on cost. A half of these goods was still held by A as at the year end. So this one means that B sold goods. So remember that note 3, it was fixed asset. Note 4, it's goods. Goods which are sold by one entity to the other. So when goods are sold from one entity to the other, that recipient now, like now A, you will find that he has resold some portion of the goods by the end of the year. So the portion which is remaining unsold, there's a profit element inside those goods which are unsold, which we have to determine the unrealized profit which is inside that unsold goods. Like now here you can see they have said A sold goods to B for 150. B marked up the goods. So B included a profit. They marked up the goods. But now what about A? They say that a half of these goods was still held by A at the year end. So we have to determine the profit which A never realized because he never resold all of the goods by the end of the year, which he received from B. Number 5, A Limited owed B 100 at the year end. With regard to the transactions in note 4 above, so A owed B. A owed B. So A was supposed to be B, 100. But now this second sentence, they say that the books of A, however, showed that it owed B only 80 million. Why not 100? Then they continued saying that A Limited had sent a check to B on 25th September. Remember that 25th September is within our present financial year, because our present financial year, you can see here, it's ending on 30th September 2016. So if they sent a check of a certain figure, which is 20, because that is the difference, on 25th, it was within the year. But when was this check received? Which was not received by B until 5th October 2016, which is 5 days after the end of the financial year. So we always say that that is a cash in transit, because by the end of the year, it was in transit. So the correct amount now here, which is outstanding, which A owes B, is 80. That is the correct one. So that 80 is the one which they know that A is supposed to pay B. And that is the correct one, the 80. Because 20 has been paid, it's only that it has not been received by B. So what you do to 80, it's all about that amount is not supposed to be carried forward. It cannot be carried forward to the next financial year. That amount is forgone in 30th September 2016. You adjust your receivables, your payables. Nobody will lose. Because by the end of the year, at the same time, that money, that element of transactions which will be occurring in the subsidiary, the parent will consolidate them. Then he will get the profit, total profit. After that is when he will share some percentages to the minority shareholders. So there's nothing he will lose. Closing off this amount of 80, there's nothing A will lose or B will lose. It's only that they are doing a consolidation. So which means that when there's an intergroup owings, that amount is forgone. It is not supposed to be carried forward to the next financial year. So you credit your receivables, you debit your payables. I will come to the question and tell you that minus under receivables, minus under payables. What about the 20? 20 was paid. So if 20 was paid, reduce your receivables by 20. That 20 will be received by B. So once it will be received by B, it will come to the bank account. So add the 20 to bank balance or cash balance. That's all. Note 6, the group uses full goodwill method. However, it does not amortize goodwill. Instead, goodwill is assessed for impairment annually. So this is not a must they could have mentioned, because already they gave us the fair value of non-controlling interest. So since you have the fair value of non-controlling interest, that one we are already satisfied that we know when we will be doing goodwill, we use the full method. So however, the only thing they mentioned maybe here of importance is concerning impairment. They said, however, it does not amortize goodwill. Instead, goodwill is assessed for impairment annually. Impairment test for the year 30 September 2016 revealed that none of the goodwill had suffered any impairment since acquisition. So there was no impairment. That is fine. So up to that point, any question before now I continue with the presentation? So the structure and shareholding. So which we know that A acquired B, A acquired C. I think those are the two entities which were acquired. So we need to get the percentage of control, the percentages of control in the two entities. So this question I will be a bit faster. So I want by 10 we are done. But at the same time, you understand. So B and C. So you were told that the number of shares were acquired, 16 and 13. So use those number of shares to give me the percentage. How can you use the number of shares to get the percentage? Use the number of shares to get the percentage. So we always do this. Like now in, let me interpret. In B, number of shares which you acquired is 16. So you go back to your capital. So B raised a capital of 200 through the issue of how many shares? They issued how many shares to raise this capital of 200? Per value is 10, per share is 10. So it means that they issued 20 shares to raise a capital of 200.
Then
So which means that you will take the one which were acquired by A, the number of shares which were acquired by A is 16.
800,000.
You divide by with 20. 20 is not about 200 divided by 10 times 100%. You are getting? Which percentage are we getting there? 16 divided by 20.
80%.
So this is 80%. Then what about B? So with this, it means that B was a subsidiary. What about C? What about C? So we have 3. You divide with the 10 because now the
30%.
so you get 30%. Because you take 3, you divide with the number of shares they issued to raise a capital of 100, which is 100 divided by 10. So that is 10. So 3 divided by 10 times 100%. 3 divided by 10 times 100%. So that is 30. And this is what the examiner tried to test you in the sitting. Nowadays, the examiner doesn't give you the percentages direct. They try to twist. By giving you the number of shares, you determine the percentage. That is how you determine. Then after that, since the requirement was statement of financial position, even if we check the dates of acquisition, it doesn't have any purpose. Anyway, we can check. So when we are preparing an income statement, timing is when is of importance, because if a subsidiary is acquired during the year, remember that you have to consider that subsidiary proportionately from the time of acquisition to the end of the year. That is in case of an income statement. But for the statement of financial position, even if a subsidiary is acquired 1 month to the end of the year, you always consider the whole amount. You don't have to apportion the transaction under the statement of financial position. So we can check, maybe it will be useful somewhere. So our financial was ending when?
30th September.
30th September 2016. So that is 30th September 2016. So which means that our financial was starting on 1st
November 2015.
November 2015.
October.
October, not November.
October.
Because now, in order to determine your timing, after this September, you move to which month?
Go to the next month,
which is October. So you write there 1st
Yes.
October. But now in the previous year.
Yes, yeah.
So when was this subsidiaries acquired? Or when was this associate? Remember that now C is an associate, B is a subsidiary. So this one was acquired in 2014, and the other one was acquired in 2015.
October.
Try to manage your background. There's someone, even if so there's someone who is making a bit of a noise. And that is fine. So you are allowed to speak, but ensure that your background there is no noise. So that is good. So these entities in the current year, they were present for the full year, because one of it was acquired in 2014, Another one was acquired in the start of this year. That is good. They were present in the full financial year. So what we do is just now we go direct and do the statement of financial position. That is what they required us to do. So we start from the property, plant, and equipment downwards to the current assets, to the equity, and so on. So we talk about, so the A is the one which will consolidate them. A is the one which will consolidate them. So I have to start on a new page. Let us present it on a new page. So I will write A limited, so consolidated, statement of financial position. As at 30th September 2016. As at 30th September 2016. So you will start from the non-current assets. So the non-current assets. So the first non-current asset was property, plant, and equipment. The PPE, the property, plant, and equipment. So the property, plant, and equipment, the figures you have, which are the figures which you have?
950, 750, and 450.
So that is
we
950 plus
750.
750. So we always consolidate parent and subsidiaries. We consolidate parent and subsidiary. So most of the things, even if yes, we will consolidate associate, but remember that we account for the associate. The parent will account for the associate using which method?
Yes.
I mentioned this last time. The parent will account for the associates using which method?
Full method.
No. That is for goodwill. Associates.
The equity method.
Equity method. Yes. The parent will account for those associates using the equity method, the same as joint ventures. So what are we supposed to adjust under this PPE? So PPE is all about like doing this T account, but I always avoid this. This just for your understanding. So we always take the parent and the subsidiary. For example, you will find that there's someone who will do this way, but this way you will be wasting your time. Anyway, you can understand. So parent plus subsidiary, that is what I have taken there, parent plus subsidiary. So if there's revaluation, obviously you will add. So which means that when I debit, I have added. So it's the same as I will come here and add revaluation. So revaluation is, remember that there was revaluation of two assets.
Equipment and patent.
But what does PPE mean? What does property, plant, and equipment contain?
Equipment and plant.
Yes, property, plant, and equipment, it doesn't contain only equipment and plant, but it contains all the fixed non-current assets. Or fixed non-current assets. They are summed up together and named as property, plant, and equipment. So intangibles are stated separately in the statement. And this one will come clear when we will be moving to a topic of published accounts. Under published, we will be able to prepare that PPE so that we can record it as one figure in the statement of financial position. So which means that the revaluation which can affect PPE, the property, plant, and equipment here is for the equipment. Because the patent, that one will go to the intangible. So in some scenarios, I will be forced to mute some guys. So speak only when I ask a question or when you have a pending issue. That is the case. So if you unmute, mute. Once you are done with speaking, then that is why everybody will be able to get an easy time to understand. So you add revaluation. So revaluation of equipment was 40. Revaluation of equipment was 40 because the difference between the fair value and the carrying amount. So I can do the workings again on the new page here. So you know that the revaluation I have already explained about it. I don't have to repeat. So for the equipment, it will be 290 minus 250. So this one will be 40. So then after that, there is a depreciation undercharge. There is a depreciation undercharge, which is arising due to this revaluation. So this 40 was never subjected to depreciation. That 40 was never subjected to depreciation. So that is why I have to take the 40, you divide with the number of years. Remaining life, that is. We were having 10 years. We were having 10 years. I think that is okay. But remember that even if when you are doing your property, plant and equipment or any other asset, when you are trying to get your net book value, you always take cost minus accumulated depreciation. So which means that my depreciation I'm using here must be accumulated. So being accumulated, it means that we have to check from which period was that asset present. So I mean this. So if I go to the question, additional information number 2, they say immediately prior to the date of its acquisition, be revalued. It's non-current asset. So prior to the date of its acquisition, be revalued. So when was B acquired? Remember, B was acquired in 2014. So 2014 to the current year, 2014 to the current year, 2016, those are 2 years. From 2014 to the end of the current year, when we are preparing our books, those are 2 years. So which means after getting the depreciation for 1 year, you have to multiply with 2 so that it can be accumulated. So this is 8. So which means that since there was a depreciation undercharge, the value of the asset was more. So we have to subtract. Then after that, we have to check UPFA. So UPFA, I said, is whereby one entity will sell an asset to the other. So this other entity which received the asset will never resell it. So since it will never resell it, it will never realize the profit the other entity realized. So which means that the profit of the other entity which sold the asset was overstated. So we have to check for that profit so that we can be able to adjust. So whereby I have to take the transfer value of the asset times the profit margin. Transfer value times the profit margin. Transfer value times the profit margin. So the asset was transferred at which figure? The asset was transferred at or was sold. So note 3. During the year, A sold an non-current asset to B for 180 million. So that is the transfer value. A marked up the equipment at 20% on cost. So you will never be told that B never resold. It's upon you to know that B will never resell. You will never be told by the exam. So this is 180. you multiply with the profit margin. So you were told that A marked up. So there was a markup, so you change the markup to margin. So the markup of the equipment was 20%. So 20% is like, so 20% is like
A fifth.
a fifth. So which
Yes.
means that margin is a sixth.
Yes.
So you add the numerator to the denominator. So that is 30. So that is the one which you add back. You subtract, not you add back. Sorry for that. You have to subtract. Because now, if the profit of one entity was overstated, the profit of one entity, the one who sold, right now A sold to B. So the profit of A was overstated by 30. So we have to adjust here because it's a fixed asset which was sold. And again, when I will go to my retained earnings, again, I have to reduce this amount. So you credit PP, you debit retained earnings. So subtracting under PP is crediting. Adding under retained earnings is crediting, but now debiting under retained earnings is so subtract, which means that I say this. So this amount will be debited under retained earnings, and it will be credited under PP. In short, that is what I have said. So this is like subtracting, and again this is like subtracting. In short, that is the way you do it. Then after this set of fixed assets, you have to check for depreciation overcharge. You have to check for depreciation overcharge. So this depreciation overcharge will arise in scenarios whereby there is this set of fixed assets. Obviously, you would be told there was depreciation under that statement whereby this fixed asset was sold. So under that statement where they mentioned that there was a set of fixed assets which occurred, you will be told there is a depreciation. So they will say during the year, A sold an non-current asset to B for 180, that is fine. A marked up the equipment, then B included the equipment, its non-current asset, and they charged the depreciation at the rate of 20% per annum. So already A had charged. So B again came in and charged. So you need to know that they did an overstatement of depreciation. So to determine that depreciation overcharge, you will take the UPFA, the unrealized profit on fixed asset. You multiply with that depreciation rate. So which means that I have to take the UPFA was 30. You multiply with 20%, you get 6. So this one must be added back because if they overcharge the value of depreciation, obviously they had already understated the value of the asset. So we have to add back to correct that overstatement of depreciation. And there's no examiner who can add another adjustment other than the one you know there. There's nothing else which can be added. That is the maximum. So once you understand that, that's all. It's like now the notes I shared. The way that formats are prepared and the adjustments I have written on those notes, you are supposed to make in every transaction which occurred. Like now, if it's revenue, I told you that you take parent plus subsidiary. You minus what? Intergroup sales, which occurred between the current year under consideration, and it took place between that parent and subsidiary. That is all. There's nothing examiner can add out of that. Yeah. So the next thing after we are done with property, plant, and equipment, that is the one which has a bit of work. The others are a bit of simple, a bit. So next we have investments. So investments, remember, is when A was acquiring this B and C, he was making investment. So when he acquired B, what you check concerning the investment, when you acquire a subsidiary, you have to compute goodwill. Then again, I said for the associates, he has to compute now the investment in that associate using equity method. So that is what we need to record to replace this investment. So goodwill, that is for the case of B, and investment in associate using equity method, that is for the case of C. And these two needs are working. Never rush to do workings because you have many marks which doesn't require a lot of workings down there. So get them fast before you go to the workings of goodwill and the investment in associate. Even you will find that just a minute, guys. The next item is concerning intangible assets. Intangible assets. So intangible assets, parent plus subsidiaries. Then you make again other adjustments which might be required. So the intangible assets, so which means that that parent was the figure for the parent. 200 plus 150. Then remember that if we added revaluation for equipment under PPE, which I said why, then again the third patent, which was revalued by 10. I think you know where is 10 coming from. Where is 10 coming from? The difference between what and what? 160 and
150.
160 and 150. So the difference. And that is according to additional information number 2. This one, they said the fair value was in excess of the carrying amount. You can see they gave you the difference anyway. They give you the two values for fair value and carrying amount. So you take the difference. It's the same way they could have said that the fair value was in excess of the carrying amount by 10. Or they could have said the carrying amount was below the fair value by 10. So that is revaluation. Then after revaluation, remember that we must have what we call amortization under charge. We cannot say it's depreciation because it's an equipment. For patent, we said it's depreciation. For patent, it's an amortization. They even say it down here. Equipment and patents are depreciating or amortized on a straight line basis over the remaining useful life respective. So which means that there's an amortization undercharge for patents, whereby we take 10, you divide the 5, 10 times 2. Because now times 2, it means that from the time when B was acquired, because they said immediately prior to the date of acquisition, B revalued its non-current asset in readiness for the acquisition as shown below. So here, remember that we have to minus that 10, divide by 5 times 2. That is how we get the answer there. So after that, we continue with the other items which are present, which is concerning current asset. Because for the non-current asset, the one which doesn't require us to do a lot of workings, we have already recorded. So the current asset is concerning inventory. So inventory, that is 250 and 200. 250 and 200. So the 250 and 200. Then what you do, you minus and realize profit on stock. that one concerning the goods which were sold by one entity to the other. Again, we do that working. So we have to check UPS and here is profit on stock. So concerning unsold goods times profit margin. Unsold goods times profit margin. So there was that goods which were sold. They called them inventories by B to A. By B to A. So number 4, B Limited sold inventories to A during the year for 150. So then you are told B marked up these goods at 50% on cost. But now, in the case of A half of these goods were still held. So that is the case we have to do. A half of 150 times margin. Markup is 50% because they said they marked up the goods at 50% on cost. So a half of 150 times the margin of a third, because a half is the markup. So margin will be a third. Because now you know that this was a half, so you add the numerator to the denominator, you get a third. So we have changed the margin to, we have changed the markup to margin. So 150 divided by 6. So that is 25. And that is what you deduct here. Then if there was goods in transit, you add. And these things I explained when we started the topic. Like now, goods in transit. If they were being sold by one entity to the other and the other entity never received them by the end of the year, these are among of the after balance sheet events. So obviously, you have to adjust your statements before they are presented to the HM. So once that those goods will come in, even after around 5 days, so we have to increase our inventory, even if they were never received by the end of the year. That is why we always add there. Then if they were on credit, again, trade payables must be increased. So the receivables, parent plus subsidiary. So 220, 170. So 2 items which you adjust here is concerning the owings and cash in transit. So if one entity owes another one, I said we forgot this amount by crediting receivables and debiting payables. So you debit payable, you credit receivable with the amount which is outstanding from one entity to the other. You cancel out. And this one is not just one entity to the other, it's between the parent and the subsidiary. Like now they said that there was another 100. There was that 100, which was outstanding, where A was supposed to pay B. But now by the end of the year, A is saying that I owe you 80. So there's a difference of 20. So we said that 80 is the correct owings, and this is the one which is supposed to be cancelled out. So again, this 20, you must reduce your receivables because it has been paid. It's only that it has not been received by the other entity. So once the other entity will receive this 20, it will add it to the cash account or bank. Again, 20, you reduce under receivable. So that is what I have done already here. 80 minus 20. 80 minus 20. Then the 80 will be subtracted under payables. 20 will be added to cash or bank. Then we have financial assets at fair value, 180, 130. So we have financial assets at fair value. So financial asset at fair value is 180 plus 130. The next was cash and bank balances. The cash and bank balances. So the cash and bank balances are already interpreted about it. So you check the parent is 100 and the subsidiary is 50. Then you add this 20, the cash in transit. So up to that point, we have total assets. We have the total assets. So after the total assets, we have to talk about equities and liabilities. As the question is, as you make the relevant adjustments. Again, let us clear our board. So another thing is we'll talk about equity and liabilities. Equities and liabilities. So under these equities and liabilities, we start with the ordinary share capital. So the ordinary share capital is that one of the parents. You pick only for the parent. And it's direct, the parent column, which is 500. So again, let me admit someone here. So I was saying that for the ordinary share capital, you take only that of the parent, the 500. The parent, I mean A. The same with share premium. For retained earnings, you have to do a working. And I always say the truth. It's around 5% of the students in a certain sitting who can score the retained earnings. That working needs a lot of practice. Yes, you can be among the 5%. But that is the only thing maybe which you can miss. Which means that if you can miss that, it doesn't mean that you are not passing. There's a lot of marks you can get other than that retained earnings. Maybe it can be difficult on your side. But it's not that difficult. It's understandable. So I have said ordinary share capital, you pick the parent, share premium, parent, retained earnings, working. What are we supposed to introduce here, which is not there? Someone? What am I supposed to introduce? There's some one item which is not here, which we always introduce. And it assists us to check.
Is it revaluation?
Other than revaluation? Other than revaluation? The one which we check capital. That is an hint. Remember that in the aspect of this subsidiary, the subsidiary was never controlled 100%. There was that element of 20.
NCI what?
Yeah, so there's this minority shareholder.
NCI.
CI,
Yes.
NCI.
So that is NCI. So there's this aspect of minority shareholders. So we need to check what was their capital in B. So we introduce that NCI. And that one again needs a working. So we say share premium, parent. So these are some of the free marks. Like now, ordinary share capital, we just write the parent figure, the share premium, the same. So the only one which needs a working is retained earnings. Retained earnings, we do working. Then the NCI, we do working. That is fine. Then we talk about non-current liabilities. Non-current liabilities. So non-current liabilities, we have 10% debenture. we have the 10% debenture. So 10% debenture was 600 plus 200. So we have to minus the 100. 100 was part of the investment. Remember, they said that they also invested in a half of the 10% debentures in B. That is why I remember explaining why the investment was not equal to the one which is given under additional information number 1. So they invested in a half of the debenture in B. So that is what the half of 200 is 100. That is what I'm subtracting. So that 100 is part of an investment. So then we have deferred tax under that. So deferred tax, you take parent plus subsidiary, of which there was just one figure. There was no so we have done 10% debenture. Deferred tax, yes, there is 250 and 100. That is fine. 250 plus 100, that is 350. That is 350. Then current liabilities. So for the current liabilities, we start from trade payables. So for the trade payables, remember that we take the parent plus subsidiary. That is obvious. You need to know that. Parent plus subsidiary. Then we adjust what? I said here we have to minus the owings. The one we subtracted under receivable. You have to minus under payable. That is how you cancel out the amount which was outstanding and it has not been settled by the end of the year. And it must have been occurred between the parent and the subsidiary. So when we subtract under receivable, we credit. When we subtract under payables, we debit. Then again, I said if the goods which were sold from one entity to the other were on credit, you have to increase our group trade payables because they were on credit and they were never recorded. This was the case for our city. So there was this one. So goods in transit, which were on credit. So we increase this because they were on credit. You know that this credit that balances. Then now, if they were never received by the end of the year, we come and record. They will be received. We increase our inventory. That is why I added under the inventory. Then, after that, there's these aspects of other items which are just direct. They doesn't require workings, like now current tax, parent plus subsidiary, which is 250 plus 150. And then again, we have proposed dividends. So they are there in the question. If you have the question, I shared through WhatsApp. You can see that this one are just 3 marks. You take the parent, you add the subsidiary, you have the answer. So you get the total equity and liabilities. So this one is 200, 250 plus 150, 400, 800, 700. So these are other items, they don't even require a calculator. This is 170. This is 200 and what? 200 or 300, 310. 220 plus 170, that is 390. 390 minus 100, that is 290. 290. Yeah. This is 425.
425 inventory. Yes.
Then the other one, so that one
356.
356.
Yes.
So that is
1716.
17.
16.
17, 16.
Yes. 16.
So are you getting 17, 16 for the others, guys? Confirm your answer again.
1708.
So that is the correct one. Ball, confirm where you have missed.
So I have a question.
Yes.
On the intangible assets,
So we move now to the working of goodwill. And remember, we have to do the goodwill of B. So A is the one which is computing the goodwill of B as acquisition date. And we know that we are using full method because already we have the fair value of non-controlling interest. So using the full method, when you are using the full method, you obviously know that goodwill will be attributable to the parent and non-controlling interest. So goodwill will be attributable to the parent and the non-controlling interest. So this is shillings, and here we have shillings. So we start from purchase consideration. So when A was acquiring B, he paid. I think you know where for it is coming from. The investment, note 1. Additional information number 1. So this for it here. Then for it to be full method, remember that we were given the fair value of non-controlling interest in this 120. So that is what we record next. So fair value of NCI, which is 120. Then you raise the share of net assets. Share of net assets acquired. So the share of net assets acquired. So the net assets concerns equity components, ordinary share capital, share premium, retained earnings, revaluation reserve. Put in your mind that the main thing of emphasis is that when you are doing retained earnings and the revaluation reserve as part of this net asset, the two must be as at the date of acquisition of that relevant subsidiary. Like now, as at the time when B was acquired, the retained earnings was, the revaluation reserve was, so those are the figures used. For the others, I'll just direct you pick from the statement of financial position. So ordinary share capital, I remember it was there, share premium. So I will go to the statement of financial position and I pick those two. Then we check the others. So for the ordinary share capital and share premium is 200 and 100. So I was saying about the retained earnings. Retained earnings, you cannot use the 350. You can't use the 350. You have to use the retained earnings as at the time when B was acquired, and that one was given in note 1. The retained earning of 150 as 1st October 2014. So we have them. So 200, 100, 150. But remember, it was an 80%. So which means that we have 80% of the 200 right now here, and the 20% of the 200, which is going to the NCI. So this is 160. This is 40. So because it's 80% of 200, 20% of 200. Share premium was the share premium was 100. So 80%, 20%. So that is 100. So this is 80 and this is 20. Then I've talked about something concerning retained earnings. So this one I've said it must be as acquisition date, or sometimes they call it pre-acquisition. So as acquisition already interpreted for you. You can see in additional information number 1, you were given 150 as at the time of acquisition. So if I use my calculator, I will say 0.8 times 150. That is 120. Then we have 0.2. So this is 30. Then finally, there is this element of revaluation reserve, which again must be treated as the same as the retained earnings, which means that as acquisition date, I don't want to write a lot of information. So we have 80% and 20% of the revaluation. Revaluation was 50. The one for equipment was 40, and the one for patent was 10. So the total is 50. I think you don't have a question on that. So this is 40, and the other one is 10. So 20% of that, 20% of that figure. So give me the goodwill. For 80 minus 160, minus 80 minus 120, minus 40. This is 80. 120 minus 40, minus 20, minus 30. You minus 10. I think
40.
So that is 40. It's 40 or 20. It's 40.
Yes.
The other
20,
is,
sorry.
you are getting
20.
20.
it's 20.
20.
Yeah, so that when you add them, it's 100.
So the goodwill there is 100. The total. Was it impaired? I think they said no. In the last additional information. They could have provided a percentage. They could have provided a percentage of impairment. But they say that the group uses full goodwill method. However, it does not amortize goodwill. Instead, goodwill is assessed for impairment annually. Impairment test for the year revealed that none of the goodwill had suffered any impairment since acquisition. And that implies that your goodwill for B is 100. That is what you record here. Then investment in associate, that is the next one. Investment in investment in associate. So you start with the initial cost of investment. So you recognize the associate with the initial cost. That is the format. Then you add with the share of post-acquisition profit. Share of post-acquisition profit. With the share of post-acquisition profit or reserve. So you add back with the two. So it can be retained profit or it can be revaluation reserve. It can be the two. Then after that, you have to raise impairment. So that is the format. Even if you would be asked theoretically to talk about equity method, you say that this is a method for accounting associates and joint ventures, whereby you recognize them with initial cost of investment, then they are adjusted with their share of post-acquisition profits or reserves, then we minus impairment loss. So initial cost of investment, remember that we are dealing with C. So the amount which A incurred when he was acquiring C, the initial cost of investment.
700.
So that was the total for the two. Remember that they gave you the breakdown here.
120.
120. So for B was
It's 120.
120. I think, Paul, you are getting that. So that is 120.
So
That is fine.
120.
That is good. So then you have to check for the post-acquisition profit. So for this one to be used here, they must be first be provided. They must be there in the statement of financial position. If they are not there, you deal with what is there. You can see under the statement of financial position, the only thing we have under equity is the retained earnings. There is no revaluation. So that revaluation of fair value and so on, you don't adjust it under this element of even if that one was there, it was not concerning anyway. Associates, because that revaluation was concerning the assets of B. This revaluation, this one was concerning the assets of B. It was not concerning C. But for it to be applicable, it must be provided. Even if it was there for the assets of C, it must first be given here under the equity part. So you will take 350 to get post. You take the balance carried down, you minus the balance which was present as acquisition date. Because now that balance which was there as acquisition date is inside this 350. It's inside this 250, not 350, because 250 is the one which is an associate. So the balance which was there as acquisition date is inside this 250, which means that this 250 is the balance by the end of. Remember that this 250 is the balance as at the end of the current year. So as at the time of acquisition, when they were acquiring this C, which means that even it was at the start of the current year. The start of the current year, which is 1st October 2015, it was 100. So that's 100, which is there at the start. Even if it's not at the start, even if it could have been previous period. So this 100 is inside here. So to get the post, we have to subtract, then we multiply with the percentage. It was 30%. So you take 250 minus the 100. So for the revaluation reserve, I said it was not there. Concerning the assets of C, there was no revaluation. But for it again to be applicable, I have said you must be provided with the relevant revaluation under the statement of financial position first, before even you think about it. So that one will be 45. So 130 plus 45, 120 plus 45, because now there is no impairment. So if they could have said that we impair the goodwill of C, in order to get impairment again, I could have went forward to do the goodwill of C, because we have not done the goodwill of C. But since already we know that, even the examiner said that the goodwill was never impaired, we don't have to waste time to do the goodwill of C. We don't have to waste time. The examiner made easier job for us. So which means that is 165, this one. Then now let us do the rest too, because I see time is not on our side. We do the retained earnings and the NCI account. And obviously I start from the NCI account because it seems to be a bit direct. You can be able to do it even if it's an exam situation. Even the first two accounts I have done, you have realized, I think, that they are not that difficult. It's all about understanding how they are supposed to be carried out. So let us again start on our new page. So we do the NCI, then we finish with retained earnings. So the NCI, you always pick the net assets this side, you credit, including goodwill and depreciation overcharge. Then on the debit side, you talk about the depreciation undercharge, UPS and impairment. That's all. So net assets, we have ordinary share capital, we have share premium, we have retained earnings, we have revaluation reserve. So those are the net assets. Then I've said including the goodwill of the NCI. Goodwill of the NCI and the depreciation overcharge. Overcharge. That is the only thing you record on the credit side. But remember that this one is on B. On B. On the assets of, on the items of B. And it was 20%. That is the percentage which was unacquired. So you take 20% of that, 20% of this, 20%, so 20%. So we multiply. And those items are just picked direct from the statement of financial position. So you pick them direct from the statement of financial position. So you copy these, 200, 100, 350. Then you remember revaluation was 50. One for equipment being 40, patent being 10. So 200, 100, 350. So 200, 100, 350. Then this is 50. Then what about the goodwill of the NCI? NCI goodwill.
$20.
The NCI goodwill was 20. So that one you put it direct because already it has been subjected to those percentages. You record it direct. Depreciation overcharge. Overcharge was?
6.
It was 6.
6.
So you pick 20% of 6. Remember, it was out of the sale of fixed assets.
Yes.
Yes, after we determined and realized profit on fixed assets. So this is 1.2. So the first one is direct, 40, 20. This one is 2 times 35 is 70. So that is how you get even without struggling. You take 2 times 2. Remember that there's 1 point. You reduce 1 0. 2 times 1, you reduce 1 0. 2 times 35, that is 70. The 1 0 goes 20. So this is 10. So that is how you do direct. Then on the debit side, so in order to know it very well, remember if we have overcharge here obviously there is an undercharge. So including UPS, but for this one to be present, the sale must be upstream.
Yes.
So B is the one which sold to A. I remember very well.
Yeah.
So 20% of 25, that was our UPS. 5. Then what about depreciation undercharge? This one was from the equipment.
It was 4.
It was 4. So 20% of 4. That one is 0.8. Goes 2 times 8. 2, that is 2 times 8. 2 times 4 is 8. But there is a point there. If it could have been 40, 20, it
No.
could have remained 8.
We are using the depreciation under charge of.
Equipment.
You said times 2 years, so it was 8.
It was 8. Oh, sorry for that. This was
Mm.
this was is 8. There's that one. The one I'm talking about is amortization under charge.
Yes,
Yes.
it was 4.
Amortization under charge. So we have to record the two of them.
Okay.
So that one, 20% of 4. That is the one which will give us 0.8.
Yes.
So the other one is 0.1. So that I can change this one.
1.6.
So this is 1.6. Give me the balancing figure so that we take it to consolidated statement of financial position. 60 plus 70, 130 plus 10 plus 1.2.
Balancing figure is 107.8.
107.
Yes.
The total is
115.2.
so 40 plus 20
No.
plus 70 plus 30
And 5
plus 1.2.
is one.
This is 161.2.
161 plus 20 plus five plus 1 plus
It's supposed to be 150,
53.8.
153.8.
28. Yeah.
And that is what you record here as NCI. So let us finish with the retained earnings. But if you do the correct ways in this way, if you are capable of doing this correctly, you can make your retained earnings to be balancing figure. You know that.
No.
If you are perfect in terms of understanding what we have been doing, if you score everything correct, your retained earnings can be a balancing figure, and you will score that. Nobody will deny you that much. I mean this. In what we have been doing, we have done everything correct.
Yes.
See what I can do, I can make this a balancing figure. Because I will add my assets. I recorded the figure there. I will add my equity and liabilities. So it will be raised by a certain amount, which will be put here. And that will be your retained earnings. So due to that, maybe you might not be doing others correct. We have to do our working to confirm.
Mm.
So retained earnings account. Now this it must be a T account because this question contains a lot of items. So you start from A. So you pick the retained earnings as on the balance sheet. As per the balance sheet. The retained earnings as per the balance sheet here is 400. Then the next thing you add back is depreciation overcharge. You remember this one was, I said under PPE, depreciation overcharge is debited. So we have credited under retained earnings. So 80% of 6. Because now I'm saying it's 80% because A controlled B up to 80%. And this was due to the fixed asset which was sold by A to B. 6 arised out of that, out of the fixed asset. Then other things you have to credit are things like UPS, UPFA, overcharge, that is undercharge. So UPS was 25. So you take 80% of 25. So things like UPFA you record it fully, 30. There was depreciation, undercharge, amortization. So depreciation undercharge was so 80% of 8. Then there was that amortization undercharge. So that amortization undercharge, 80% of it was 4. So up to that point, if there could have been impairment again, you record. So that one concerns A and B. It concerns A. It concerns A, not A and B. So if you take 0.8 times 25, this is 20. Then 0.8 times 8, 6.4. 0.8 times 4, 3.2. So this is the answers I'm getting here. Then this one was not there. Then for B limited, again, you go to your balance sheet, pick the balance which is there. So let me get this one. This one was 4.8. So I have said for B, you pick the balance from the balance sheet. Then on the debit side, you record the pre-acquisition of that retained earnings for B. Pre-acquisition means that as at the date of acquisition, when B was acquired, the retained earnings was. So as at the date of acquisition, it was in addition information number 1. When B was acquired, 150, that is fine. So 150, you say 80% of 150. 80% of 150. Because B was controlled up to 150, up to 80%, not 150. So 120 is the answer. Then in this 350, remember that there was an NCI. So you pick 20% of that 350. Because B was controlled up to 80. So 0.2 times 350. We have 70. Then finally you finish with the C. So for C limited, you just pick the post-acquisition. You pick the post-acquisition retained earnings of that C. And we did this one when we were doing the investment in that C, investment in that associate. Investment in the associate, this one, I was looking for that. So we did this. So we have to record that it was 45. Yes. So this 45, remember how we got this 45? We took the balance carried down, you minus the one which was there as acquisition date. You multiply with the percentage. So I can write this one 30% to 50 minus 100. So we got 45. And that is how you are done with the retained earnings account. That is how you would be done with the retained earnings account. So balance that account so that you can say that we are done. 400 plus 4.8 plus 350 plus 45. That is 799.8. So So 799.8. So the balancing figure will be, so 20 plus 30 plus 6.4 plus 3.2 plus 120 plus 70. So I'm getting 550.2. So that is to consolidated statement of financial position. And that is what you record as your retained earnings, 550.2. So this one, 550.2. 550.2. So let us try balancing. Let us try balancing. Let us balance. So sorry for that. So let us try balancing. Add the assets. Then add equities and liability. Check if it's balancing. You can even add together. 1708 plus 100 plus 165 plus 356 plus 425 plus 290 plus 310 plus 170. What are you getting?
3520.
3524. So then the other side, for the equities and liabilities, 500 plus 200 plus 550.2 plus 153.8 plus 700 plus 350 plus 400 plus 200. What are you getting? What are you getting on your end? So remember, there's something here we never recorded.
3054.
There's one item here which is never recorded here. Between the two, I can see there's something missing. Which one? 350 plus 250 minus 8 is
350 plus
250 minus 80.
minus 80. 520.
520. So remember that this one was for current. So add 520 to that answer. It's 520.
Yeah.
If you check your trade receivable is the one which is having issues. Let us open that. So this trade payable, not receivable, trade payable, 300 plus 250. You see this?
Yeah.
So which means that this is 300 plus 250. Then we are discharged by subtracting intergroup owings. That is
470.
So this is 470. So your answer was initially. It was 3054 or 31. Add again anyway to confirm. 500 plus 200 plus 550.2
Plus 700. No. 153.8 plus 700 plus 350 plus 470 plus 400 plus 200. 3524.
that is 5. That is fine. 35. So that is how you were supposed to do this question. That is how you were supposed to do the question. And that marks the end of the session for today.